Imagine you have never missed a single mortgage payment in your entire life. Every month, without fail, the money leaves your account automatically. You sacrificed vacations, delayed car upgrades, and lived well below your means specifically to protect that one payment. And yet, one ordinary Tuesday morning, you open your mailbox and find a registered letter from your bank informing you that your home is being listed for sale, and there is absolutely nothing you can do to stop it. This is not a hypothetical scenario. This is a legal reality that thousands of Canadian homeowners are currently navigating, and the mechanism behind it is one of the least understood financial structures operating inside the Canadian mortgage market today. Most people who sign a mortgage in Canada believe they understand what they are agreeing to. The monthly payment, the interest rate, the amortization period, those numbers feel like the entire contract. But embedded inside the documents that millions of Canadians have signed over the past 15 years is a legal framework that fundamentally changes the relationship between a borrower and their bank in ways that almost nobody sitting across from a mortgage specialist has ever had carefully explained to them. That gap between what people believe they signed and what they actually agreed to is the subject of this video. And if you currently carry a mortgage in Canada, what follows is directly relevant to your financial situation. Before we get into the mechanics of how this works, it is worth pausing to consider why this topic does not receive more mainstream attention. The collateral charge mortgage has become the default product offered by Canada's largest banks, which means this is not a niche issue affecting a small segment of the population. And it is a structural feature of the Canadian mortgage market that applies to a very large proportion of current homeowners, most of whom have no clear awareness of the legal implications they accepted when they signed their documents. The reasons it remains underexplained are not difficult to identify. The products are legal. The disclosures, while inadequate in practical terms, technically exist, and the consequences of the structure only become visible under conditions of financial stress, which means that during the long period of low interest rates and rising property values, the cross-default mechanism sat quietly in the background without creating visible problems for most borrowers. The economic conditions of the past 2 years have changed that calculus substantially, and that is why this conversation is worth having now, with as much clarity and accuracy as possible. To fully understand how this situation develops, you need to go back roughly 15 years and examine a deliberate and largely silent shift in how Canadian banks began structuring their mortgage contracts. For most of the 20th century, the standard instrument used to finance a Canadian home purchase was called a standard charge mortgage. The concept was legally contained and relatively straightforward. If a bank lent you $400,000 to purchase a property, and they registered a legal claim against that property for exactly $400,000. As you paid down the principal balance over the life of the loan, the bank's legal claim against your home decreased proportionally. More importantly, that legal claim was isolated entirely to the mortgage itself. It had no legal connection to your credit card account, your vehicle financing or your personal line of credit, even if all of those products were held with the exact same bank. If you lost your job, accumulated significant credit card debt, and eventually defaulted on unsecured consumer obligations, the bank would pursue collection and damage your credit profile. But as long as your mortgage payments continued arriving on time every month, your home was legally protected from those secondary defaults. The separation between different categories of debt was not simply a matter of bank policy or goodwill. It was a genuine, enforceable legal boundary that gave homeowners a meaningful degree of protection during periods of financial stress. That boundary functioned as a firewall, and for decades, Canadian homeowners could reasonably rely on it. Over the past decade and a half, that legal boundary has been systematically removed by the major Canadian financial institutions. They replaced the standard charge mortgage with a fundamentally different legal structure called the collateral charge mortgage. And the transition happened so quietly and was packaged so effectively as a benefit to consumers that the vast majority of Canadian homeowners signed the new documents without understanding the implications of what they were agreeing to. The mortgage specialists who presented these new products described them as flexible and convenient. They explained that by registering the mortgage for more than the actual loan amount, and sometimes as much as 125% of the appraised value of the property, the borrower could access additional credit in the future without paying new legal registration fees or returning to a real estate lawyer. More borrowing power, less administrative friction, greater financial flexibility over the long term. That was the pitch. And it landed effectively with millions of homeowners who were watching property values climb steadily and who wanted to be positioned to leverage that growing equity efficiently when the need arose. What those homeowners were not clearly told is that a collateral charge mortgage operates under something the banking industry internally refers to as a master borrowing agreement. Under this structure, the legal claim registered against your property does not secure only your mortgage, and it secures every credit product you hold with that same institution. Your home equity line of credit, your personal line of credit, your vehicle financing, your credit card accounts. All of it becomes collateral legally secured by the same property. The practical boundary between your different debt obligations disappears entirely, replaced by a single integrated legal agreement in which your family home functions as the universal guarantee for your entire financial relationship with that bank. The convenience that was sold to you, the ability to borrow more without paying legal fees, came packaged with a structural change that most borrowers were never adequately informed about. And that structural change carries consequences that only become fully visible when something in your financial life goes wrong. And this integrated structure introduces a legal clause that most Canadians have never heard described clearly, but that carries deeply significant consequences for anyone carrying multiple debt products at the same lender. It is called the cross-default clause. The language used to describe it in standard mortgage documentation is dense, technical, and written in a way that is genuinely difficult for most people without a legal background to interpret accurately at the point of signing. But the operational meaning is direct and severe. If you default on any single credit product covered by the master borrowing agreement, that default is automatically and immediately treated as a default on every other product covered by the same agreement. A missed payment or an unfulfilled demand on your home equity line of credit does not stay contained within that account. It legally contaminates your primary mortgage. The status of your home loan changes the moment any connected obligation falls into default, entirely regardless of how consistently and perfectly you have maintained your mortgage payments up to that point. The history of 15 years of on-time payments becomes legally irrelevant the moment the cross-default mechanism activates. To understand how this plays out in concrete terms, we'll consider a scenario that has become increasingly common as Canadian interest rates have risen substantially over the past 2 years. A homeowner carries a primary mortgage and a home equity line of credit with the same bank. During a period of financial pressure caused by rising costs and reduced household cash flow, they fall behind on obligations attached to the credit line. The bank, after reviewing updated property valuations generated by automated internal systems and determining that the homeowner's equity position has declined below the threshold specified in their risk management frameworks, issues a formal demand letter requiring immediate repayment of the full outstanding balance on the HELOC. The homeowner is given 30 days to produce the full amount. Unable to arrange alternative financing on that timeline and unable to quickly liquidate other assets, they cannot meet the demand. The credit line falls into default because the cross-default clause is embedded in the master borrowing agreement that governs both products. That default on the secondary credit product automatically places the primary mortgage in default as well, despite the fact that every single mortgage payment has been made correctly and on time throughout the entire relationship with the bank. The institution then invokes what is typically called an acceleration clause, which allows them to declare the entire remaining principal balance of the mortgage immediately due and payable in full. The homeowner is no longer simply behind on a credit line. They are now in default on their entire mortgage balance, and the bank holds the contractual and legal right to initiate power of sale proceedings against the property to recover the total outstanding debt across all products simultaneously. The speed at which this enforcement process moves, once it is formally initiated, is one of its most practically significant and devastating features. Once the default is registered in the bank's internal system, the file is typically transferred quickly to an external legal firm that handles mortgage enforcement at high volume. Legal fees begin accumulating immediately and are added directly to the outstanding balance the homeowner is required to repay in order to stop the process. The property is formally appraised, often producing valuations that reflect the urgency of liquidation, rather than a patient approach to achieving fair market value. In a declining or illiquid real estate market, power of sale listings routinely transact at prices meaningfully below what a homeowner might have achieved through a conventional listing with adequate time to attract competitive offers. The discounted proceeds from the completed sale are then applied to the bundled debt in a sequence determined by the terms of the master borrowing agreement, covering accumulated legal costs first, then the accelerated mortgage balance, then the defaulted credit line balance, and then any remaining consumer obligations that fall within the scope of the agreement. If the total proceeds from the sale fall short of the full amount owed across all products and associated fees, the remaining shortfall does not simply disappear. The bank retains the right to pursue a deficiency judgment through the provincial courts, creating a legally binding obligation that can allow them to garnish future wages and claim future assets until the remaining balance is fully recovered. The homeowner loses the property and may still carry a legal debt obligation for years afterward. The regulatory environment governing these contractual structures is one that consumer finance researchers and legal scholars have examined in academic and policy contexts over a number of years. The Office of the Superintendent of Financial Institutions provides oversight of the Canadian banking sector and establishes the framework within which these agreements are permitted to operate. The collateral charge and cross-default structures are fully permissible under current Canadian banking regulation, and while disclosure requirements technically exist within mortgage documentation, and there is no standardized obligation for lenders to explain the practical implications of cross-default provisions in plain language at the point of signing. Most borrowers encounter these clauses for the first time not when they are signing their mortgage documents at the bank, but when they receive a demand letter and attempt to understand what legal options are available to them. That sequence, learning about the mechanism only when it is already being deployed against you, leaves very little room to respond effectively. Some consumer advocacy organizations have called for mandatory plain language summaries that specifically explain cross-default provisions at the point of signing, similar to disclosure requirements that exist in other financial product categories. Whether those recommendations lead to regulatory change remains to be seen, but in the current environment, the practical implication for homeowners is that they should not rely on the assumption that they were fully informed at the time of signing. Taking time now to read the actual terms of your mortgage agreement, and if necessary, consulting with a real estate lawyer who can explain the specific clauses in your particular contract, and is a reasonable and proportionate response to the risk environment that currently exists. For homeowners who currently carry a collateral charge mortgage alongside other credit products at the same lender, there are specific and actionable steps that are worth understanding clearly. Confirming whether your mortgage is registered as a collateral charge or a standard charge is possible by reviewing your mortgage documentation or contacting the Land Titles Registry in your province. If your mortgage is a collateral charge and you also carry a HELOC, a personal line of credit, or other credit products with the same institution, the cross-default exposure exists as a contractual reality. Consulting with an independent mortgage broker about refinancing options is worth pursuing seriously if your current equity position and verifiable income support qualification at a new lender. Moving your primary mortgage to a lender that registers a standard charge, while maintaining consumer credit at a separate and legally unconnected financial institution, removes the bundling that makes cross-default exposure possible in the first place. The costs associated with that transition, including any applicable prepayment penalties, legal registration fees, and the qualification process under the federal mortgage stress test at a new lender, need to be evaluated honestly against the degree of financial risk reduction that legal separation provides. For many homeowners in stretched financial positions, the cost of separation is real and meaningful, but so is the risk they currently carry without fully recognizing it. If refinancing is not currently feasible given your income and equity position, systematically reducing the outstanding balances on credit products held at the same institution that carries your mortgage directly reduces your exposure to a cross-default situation. Every dollar of principal paid down on a connected credit line reduces the likelihood and potential severity of a formal demand, and it increases the buffer between your current financial position and the thresholds that can trigger enforcement activity. In a rising rate environment where automated valuation systems are continuously recalculating collateral values, that buffer matters more than it did during years of rapid property appreciation. The broader economic context surrounding these contractual structures is relevant to how urgently this information applies to Canadian households right now. Canadian household debt levels remain among the highest in the developed world relative to household income, and the rapid and sustained increase in interest rates beginning in 2022 has significantly increased the carrying cost of variable rate products and will continue creating pressure on borrowers as fixed rate mortgages reach renewal dates over the coming years. Property values across many Canadian markets declined substantially from the peaks recorded in late 2021 and early 2022. These three factors together elevated aggregate debt loads, significantly higher borrowing costs, and when reduced collateral values create the precise conditions in which the legal mechanisms described here become most practically relevant to the largest number of borrowers at the same time. Homeowners who were well within comfortable loan-to-value thresholds 2 or 3 years ago may find themselves in materially different positions today without having made any changes to their own behavior, is simply as a result of market conditions and rate movements that their agreements were designed to account for in the bank's favor. The details embedded in mortgage contracts are not abstract legal technicalities. They define the actual rights and obligations that govern one of the most significant financial commitments most Canadians will make in their lifetimes. Understanding the specific structure of your mortgage registration, the clauses that connect your different credit products legally, and the conditions under which your lender can accelerate repayment or initiate enforcement is a practical and important part of managing household finances in the current environment. If this kind of clear analysis is useful to you, subscribing ensures that future examinations of Canadian financial and legal frameworks will reach you as they are published. The distance between what is written in financial contracts and what most Canadians understand about those contracts is significant, and examining it carefully, accurately, and without exaggeration is a conversation worth continuing. The questions raised by the shift from standard charge to collateral charge mortgages and the implications of cross-default provisions for Canadian families managing multiple debt products deserve clear public discussion. Sharing this video with someone who currently holds a mortgage in Canada is one practical way to make sure that conversation reaches the people for whom it is most relevant. The information exists in the contracts. Making it accessible and understandable is what this channel is committed to doing.